Welcome to The Explainer. Today, we are digging into a fascinating analyst report on a company called Nordic Group to really understand its investment potential.
So, the report kicks off with this really bold number, 37%, as in potential upside. Now, a number like that, well, it definitely gets your attention, right? So, let's dive in and see what's actually behind it.
And that really is the big question, isn't it? What is driving all this optimism for an engineering company? To figure that out, we're going to explore both sides, the bull case and the bear case, to get the complete picture.
Okay, so first things first. Let's get a clear idea of who Nordic Group is and exactly what it is they do. So, they're a Singapore-based company, but their operations are, well, they're everywhere. They provide some pretty essential services in a dozen different industries, everything from semiconductors and defense to infrastructure and marine services.
And this map right here gives you a great sense of that global reach. Even though their headquarters are in Singapore, they have a presence in 18 different jurisdictions, with factories and service offices all the way from China to Germany.
All right, let's get to the optimistic view, the bull case. Why did the analyst who put this report together kick things off with a strong buy rating?
You know, the core of the bull case really comes down to their strategy, which seems both clear and pretty effective. They've been actively buying up companies to expand what they can do, and at the same time, they're making a really smart pivot toward more predictable, recurring maintenance revenue instead of just relying on one-off projects.
And this strategy, it's delivered some pretty tangible results. Since 2010, they've pulled off a compound annual revenue growth rate of 9.3%. That really shows their acquisitions have had a real impact on the top line.
And their recent momentum is looking really strong. In just a single month, they announced over 70 million Singapore dollars in new contracts. That gives them some seriously strong visibility into future revenue.
Now, a huge part of their strategy is moving into sectors with some serious long-term momentum. Through acquisitions, they've added capabilities in defense and aerospace maintenance, and they also bought a company that gave them a foothold in environmental engineering. Both of these areas are backed by significant government spending and big global trends.
And on top of all that, the bigger economic picture looks pretty supportive. The report points to easing interest rates, which could stimulate industrial activity, falling inflation, which could help their profit margins, and a solid rebound in Singapore's own industrial production. It's like having the wind at their back.
But, you know, every investment has risks. It's not all good news. So let's look at the other side of the coin, the bear case. What are the potential red flags here? A key risk is right here in their revenue mix. Even with their pivot to more stable income, it's still pretty much a 50-50 split between project services and maintenance. And this creates a kind of fundamental tension in the business, a tug-of-war between predictable income and lumpier, less certain project work.
The difference is pretty stark. Project services are non-recurring and way more cyclical. They're heavily dependent on how the broader economy is doing, and that's led to some inconsistent bottom-line performance for the company in the past.
So the key risks really boil down to this: a heavy reliance on the Singapore market, the ever-present threat of inflation coming back, and of course, competition from lower-cost players in the region.
So after weighing all the arguments for and against, where did the analyst actually land? Let's take a look at the final numbers.
Well, the analyst is forecasting steady, continued growth. Both revenue and net income are projected to increase consistently over the next 2 years. The belief is that the rebound in the industrial sector will continue to be a tailwind for Nordic.
Now, to come up with a price target, analysts use a key metric called the price-to-earnings, or PE ratio. The easiest way to think about it is like a price tag for the stock based on how much profit it's generating.
The analyst applied a target PE multiple of 11.3 times. Now, this number wasn't just pulled out of thin air. It's right in line with Nordic Group's own 10-year historical average PE ratio.
And when you apply that multiple to their forecasted earnings, you get a fair value estimate, or a price target, of 59 Singapore cents per share.
Which brings us right back to where we started this whole thing. The final verdict is a buy rating, based on that potential 37% upside from its share price when the report was written.
So, this leaves us with the final question. The company is trying to build a more resilient business by balancing its portfolio. The big question for any investor is whether this strategic blend of stable, recurring revenue and higher growth cyclical projects is the right formula for long-term success. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.